Assalamualaikum. My name is Nisrina Biha binti Nur Shanisa. My number is 06D8023F1115. I will present case 2 for case study professional ethics. This is case 2. I will explain about this case. Describe the ethical problem. The theft of business asset and willful understatement of revenue and tax obligation constitute the main ethical issues. First is financial integrity. Processing sales outside of an accounting system leads to fraudulent tax return and erroneous financial statement, overstated inventory and understated revenue. Secondly is conflict of interest. As the external accountant, your ultimate relationship with the director and owners poses a risk of both familiarity and self-interest, which could undermine your objectivity and integrity when handling the situation. Lastly is non-compliance with law and regulation, which is NOCLA. The accountant is required to act in the public interest because the unrecorded sales and subsequent use of funds for a private benefit, like a Christmas party, violate tax law and possibly the Company Act of 2016. Next is identify the affected parties. First, you, the accountant, and your company could face legal and professional repercussions, reputational damage, and even MIA disciplinary action. Secondly is the client business start-up. Internal control are lacking, its financial statements are deceptive, and tax authorities may find it or take legal action against it. Third is the owner and director are directly in charge of approving or condoning the unethical and unlawful behavior as said theft and tax evasions. Next is tax authorities, the people who receive false tax returns such as the RRB. Lastly, a leader and creditor make decisions based on the financial statement that are materially inaccurate. Next is guiding question and ethical evaluation. First question is which fundamental principle feature more prominently for safeguarding. Protecting the following values must be the accountant's top priority because the client behavior and their close relationship directly jeopardize them. The most important quality is integrity. Accounts or tax returns that are known to be deceptive cannot be linked to the accountants. Professional behavior. The accountants must abide by all applicable law and rules and refrain from any behavior that could bring the profession into disrepute, such as approving false and tax return. Objectivity. The intimate connection generates a self-interest trait because of the desire to keep the lucrative client, and a familiarity trait because of an overly tolerant or accepting attitude towards the director behavior. The firm established ethical conflict resolution procedure must be used to regain objectivity. Lastly is professional competence and due care (PCDC). The accountant must exercise due care by carefully investigating non-material irregularities. Next question is what will be your key consideration in your approach to resolving the dilemma presented? First is materiality and legality. The rationale based on MI by law is, does the sum matter? More significantly, the act is illegal and essentially dishonest, tax evasion, misappropriation. Regardless of financial materiality, the NOCLA standard must be applied due to the illegality. Secondly is urgency. The company is preparing tax return and year-end accounts to avoid breaking the law. The problem must be fixed before any document are completed and submitted. Thirdly is confidentiality versus public interest. When disclosure is mandated by law or when there is a professional obligation to notify the proper authority, such as the RIB, of NOCLA in the event that management decline to take action, the duty of confidentiality is superseded. Lastly is internal safeguard. To mitigate the risk of personal self-interest and familiarity, the first step is to internally consult with the other partner to ensure a collective decision. Last question. What course of action will you take to resolve the dilemma? The plan of action adheres to the NOCLA framework. First, internal discussion. Talk to your two partners about the problem and record the facts. Seek guidance and strong agreement regarding the moral and legal responsibilities. Second, talk to director. Call a meeting of the owners and director of the client. Clearly state that the procedure is theft of business property, unlawful evasion of taxes, result in a violation of the accountant's professional integrity duty. Third is demand corrective action. Request that the director take the following immediate action. Put an end to the unrecorded sales technique. Calculate all previous unrecorded income and outlay for the Christmas party funds. Make the necessary corrections to the financial statement and send the RIB the updated tax return, accepting any fines or penalty that may follow. Consequence, if reversed, you must immediately leave the engagement and give the client written notice of your resignation if the director do not act appropriately and properly. Since not compliance with tax law poses a threat to the public interest, ascertain whether a report to the RIB is required under the NOCLA provision. Next is evaluate each solution. Solution option. Evaluation against principle. Why it is or is not viable. First is solution A. Insist on correction. Upholds integrity and professional behavior. Best viable option. If the client cooperates, it eliminates the threats and permits the professional relationship to continue. Solution B. Ignore the issue. Violates integrity and professional behavior, unacceptable. Put the accountants at risk of legal trouble and harsh MIA disciplinary action. This solution is not professional. Solution C. Resignation and reporting. Upholds integrity but severely breaches confidentiality unless legally required. Last resort, only required in the event that solution A is unsuccessful. In order to adhere to NOCLA regulation concerning external reporting, it needs to be handled carefully. The best solution was selected, solution A. Demand that the practice be stopped immediately and that the tax return and financial statement be fully corrected. Justification. This solution was chosen because it complies with the ethical framework's requirement to lessen the threats to a manageable level, while giving the client the first chance to correct the violation before it worsens. It puts the public interest, accurate tax reporting, ahead of the client's self-interest in keeping the clients. You are fulfilling your obligation to act with integrity and professional behavior under the MIA bylaw by doing this. Conclusion for Case 2. Due to non-compliance with law and regulation NOCLA, the ethical conundrum in Case 2 involving unrecorded sales and asset misappropriation for a staff party poses a serious threat to integrity and violates the MIA bylaw. The last duty of a professional accountant is to put the public interest ahead of the client relationship. The directors must immediately stop the practice and make all necessary corrections to all financial and tax documentation in order to implement the best option. The accountants must consider their mandatory obligation under NOCLA to report the non-compliance tax evasions to the relevant authorities and resign from the engagement immediately if the director refuses to comply. Thank you.